Hello friends, welcome to Learning Sessions, and in this particular case study we'll be learning about the application of the different type of foreign currency rates. So kindly please do confirm the audio video quality so that we could proceed. And further, if you're new to our channel, please do subscribe the channel, press the bell notification icon so that you get updated whenever we upload the new video. The full course videos are available at our website iibf.info, where you can get the chapter wise full course videos, case study videos, chapter wise previous questions, mock test, and also the complimentary access to the ePDF notes through our Android application. So do enroll right now, and if you want to join us on our WhatsApp group or Telegram group, the link is in the description below. So do visit right now and further enroll to the courses over there. So audio video quality over here seems to be working fine. So let us start the session now. The case study over here, it is related to foreign currency rates application. So it says following are the interbank quotes on a certain date. Spot rate is given for the USD and the spot GBP rate to USD rate is given over there. And further it is given date. All the above differences are for the month, and for the fixed dates, and the bank margin is said to be 3 paise over there. Now the question number 1, it says an exporter has presented an export demand bill. An exporter has presented an export demand bill USD 3 lakh under irrevocable letter of credit. So under irrevocable letter of credit means that letter of credit which cannot be cancelled or amended without the consent of the beneficiary. Under that particular letter of credit, the exporter has basically drawn a export bill which was drawn and further was accepted by the importer. So here we will be considering an exporter who has drawn a export bill and further it was got accepted by the negotiating bank, because under the letter of credit the export bill is negotiated with the negotiating bank, and the negotiating bank over here has accepted the bill over here, and further now the bill is available to the exporter, that is the export bill over here. Now the exporter went to the bank. Let us take the case, the exporter's bank to be XYZ over here, who will be discounting the bill over there, and further it says what will be the rate at which the documents will be negotiated. At what rate the documents will be negotiated, that we need to conclude over here. So over here the bill is drawn in USD, so we will be looking at the spot rate USD to INR over here, that is 44.60/65 over here. And further it is said to be what, that it is the export demand bill. Now there are two type of bills, one it is a demand bill and the other one it is a usage bill. Now the usage bills are those bills which are not payable on demand and will be payable only and only after some due date or at some particular time over there. That is basically the usage bill, and over here it is said to be the demand bill, which when presented the opposite party has to pay the amount over there. Okay, so it is related to demand bill over there. So whenever we talk about the demand bills and the other types of the bills, the rates applicable are basically what type of bill rates, whether it could be the case that it will be the case that bills rate would be applicable, or it could be the case that the telegraphic transfer rate would be applicable. No, but in the case of the telegraphic transfer rates, as you must have been already aware of, that there is no settlement day difference, that the settlement do occur at the same time in both the centers. Okay, so over here also there is no gap in between. When the bills will be presented, the amount is to be paid by the customer itself. So what rate shall be applicable? It will be the TT rate that shall be applicable. It will be the TT rate, that is the telegraphic transfer rate, that shall be applicable. Now we need to ascertain it will be the buying rate or the selling rate, that it will be the TT buying rate or it will be the TT selling rate. Now think from the bank point of view. Now exporter wants to sell the USDs. Now the exporter is having the 3 lakh USDs bill, and further he want his account to be credited with the equivalent amount of INR. For that particular purpose, he needs to sell the USDs. So for selling the USDs, the exporter will be able to sell only at that particular rate at which the bank is ready to buy. So what rate shall be quoted by the bank over here? It will be the buying rate shall be quoted by the bank over here to the exporter. So what rate it shall be used? It shall be the TT buying rate that shall be used in this particular scenario. So it will be the TT buying rate which will be used. And what is the formula related rate? It is a spot rate. And further, let me tell you that in case of selling rates, whether it is a TT selling rate or the bills selling rate, the exchange margin is added up. But in the case of the buying bills, whether it is a case of the TT buying bill or whether it is a case of the bills buying bill, the exchange margin is subtracted. Okay, so over here the exchange margin is to be subtracted, which is given to be what? Which is given to be 3 paisa in this particular scenario. Spot rate will be considering over here. So this is a buying rate, and further this is a selling rate. So what rate shall be quoted? It is a buying rate that is to be quoted, that is 44.60. So the spot rate that we'll be using, it will be 44.60 minus the margin that is given to be of 3 paise. So it is 0.03. So this is to be subtracted, and what rate shall be over here? It is 44.57. So that particular rate will be used for under this particular transaction as per the scenario given over here. Okay, so that is related to question number 1. Question number 2 over here, it says an exporter has submitted 60 days usage bill for USD 25,000 for purchase. At what rate the documents will be purchased? Okay, we need to tell at what rate the documents will be purchased. So over here the scenario is the exporter went to the bank, which was accepted by the negotiating bank over here, and for the here it is a usage bill. Here it is a usage bill, so there will be some credit period. So there it is some credit period which is allowed by the exporter over here, and the credit period over here it is given to be 60 days. That the exporter cannot get the payment before 60 days. That is obligation, na? That is obligation that only and only after 60 days the bill can be presented, and further the payment will be made by the importer or the importer's bank over there. So that is the case over there. So exporter has submitted 60 days usage bill for USD 25,000. So one thing is sure over here, that the telegraphic transfer rate is not applicable. Why not applicable? Because the settlement date is not going to be the same in both the centers over there. So that is why what rate shall be applicable? It will be the bills rate will be applicable. Now we need to find it out that it will be the bills buying rate or the bills selling rate. So there are two types of bills rate. One, it is a bills buying rate, and the other one, it is a bills selling rate over there. Now over here, just look at the scenario that the exporter has submitted the bills with the bank over there, which is a 60-day usage period is over there. Now the bank is having, now the bank is to credit the exporter with the equivalent amount, and further the bills will be presented after a period of 2 months, and only after that the bills will be cleared, and the amount will be utilized so as to set off the amount, so extended to the exporter over there. Okay, so that is the scenario. Now in this particular case, same scenario is there where exporter want to sell once the USDs will be credited to the bank's nostro account. The exporter is to sell the USDs. At what price the bank will be buying the USDs? At the buying rate only. Okay, so what rate shall be applicable? It shall be the bills buying rate will be applicable. So what is the formula related rate? It is a spot rate. So bills buying rate formula is, it is the spot rate plus minus the forward premium or discount. And for the, in case of buying bills, I already told you the exchange margin is subtracted minus the margin. So the spot rate is 44.60/65. The rate is same over here, that is 6065. Over here we are having the buying rate, and over here we are having the selling rate. So what rate shall be applied? So it is 44.60. And what is a 2 month forward points over here? Those are given to be 18/20. So these are the buying points, these are the selling points, and you must be aware of the fact that if the selling points are greater than that of the buying points, in that case it is a case related to premium. And the currency is available at premium. If the currency is available at premium, in that particular case, if the currency is available at premium, the forward points are added up. And which points will be adding up? 18 points will be added up, because we are considering the buying rate over here now. So the 18 forward points will be added up over here. So it will be equal to 44.60 plus 0.18, that is equal to 44.78. Okay, because that particular premium is to be added up in this particular case, minus the margin. The margin is given to be 3 paise, that is 0.03. So what rate shall be applicable? It is 44.75. This particular rate will be applied over here. And this is the rate at which the documents will be purchased by the bank itself. Okay, so that is a scenario over here. Let's move to the next question over here. It says your bank has opened the letter of credit for the import at the end of 2 months for GBP 30,000. At what rate the forward exchange be booked? So the scenario over here is that a loan is sanctioned in a way, and further for that particular purpose the bank is to book the forward rate, and further the transaction is related to the import over here, that the amount is basically related to import, and import has to be made, and whensoever an import is made by the importer, the amount is to be paid. the amount is to be paid. So let me tell you the scenario. The scenario is that the letter of credit is being basically opened in GBP, that is a Great Britain pound, and further the amount will be paid in GBP only. The importer will be paying the amount in GBP only, and what amount is to be paid? 30,000 GBP amount is to be paid. And 30,000 GBP amount will be paid, and after what duration the amount will be paid? The amount will be paid after 2-month period. It will be paid after 2-month period. And particularly over here, if I tell you that what rate will be applicable, would it be the TT rate or the bills rate, what rate will be applied? Because the transaction is not to be happen today itself. Now the transaction is going to happen after 2-month period. So what rate shall be applicable? So what rate shall be applicable? It will be the rate related to the forward transaction. It will be the rate related to forward transaction, because the settlement is not going to happen in the same date over there. Na? The settlement is going to happen not in the same date over there. In that particular case, the rate applicable will be the bills rate. The bills rate will be the applicability. We will be having the applicability over here. And further related to that, it is what type of transaction? It is related to that importer wants to pay the amount in GBP, 30,000 GBP over here. So what rate shall be applied? It will be related to that importer want to purchase the GBP. For that particular quote, what rate shall be quoted? It will be the selling rate that shall be quoted. So over here we are having the buying rate, over we are having the selling rate. So what rate shall be quoted? It will be the selling rate that shall be quoted. So it is 1.7510. That rate is quoted. And further let me tell you that we are having it is to be basically amount is to be paid after 2-month period. So it will be the 2-month forward point that you will be considering. That is 50/40. 50/40. Now these are the buying forward points, these are the selling forward points. If selling forward points are lesser than that of the buying forward points, it is a case that currency is available at discount. Whenever the currency is available at discount, the forward points are to be subtracted. And what points will be considering? We'll be considering the selling forward points over here, which are to be subtracted over from here. So we will be subtracting the forward points 0.0040 from here. 0040 over here. So it will be the case that 1.7510 minus 0.0040. So answer will be 1.747. So the rate applicable is 1.747 after 2-month period. Okay, so at what rate the forward exchange will be booked? It will be booked at 1.747. Is that particular point clear over here? But also we have not basically added up or subtracted the margin from there. So I just told you that the bills rate would be applied. And what bills rate would be applied? It will be the bills selling rate which will be applied, because the motive of the importer was to purchase na. So that is why what rate will be quoting? Will be quoting the selling rate. So bills selling rate will be applied. So in the case of the selling costs, whether it is the TT selling cost or the bill selling cost, the exchange margin is to be added up. So we will be adding up this exchange margin of 3 paisa over here. So the amount that shall be the rate which will be applied over here, at which the foreign exchange will be booked, it will be 1.750. It will be 1.750. That particular rate shall be applied. Is that clear? So that would be answer related over here. And over here you also need to ascertain one particular point, that is basically question based. So if your options are being provided into INR over here, in that particular case you need to ascertain the INR rate by using the cross rates over there, because we have no direct relationship between the GBP to INR. So over here in this relationship we are provided with GBP to USD. So over here the rate quoted is GBP to USD. So whatsoever rate we are calculating over here, that was GBP to USD. So if you just simply calculated the USD, the options are in USD itself, then 1.750 will be the answer. Otherwise you need not to enter the margin over here. If the options are given in INR over there. If the options are given in INR over there, in that case you need to ascertain the GBP to INR rate over there, and that can be done by using what method? By using the cross rate method. So we are provided with the rate, that is GBP is equal to USD 1.747 USD. So that is a relation between that, and particularly we are provided with that 1 USD is equal to what? That 1 USD is equal to So if you look at over this scenario, this is given to be 44.60/65, that is 1 USD is equal to 44.60/65 INR. And further, we need to look into 2-month forward period over here because the question is related to 2 month only. So we'll be considering the same rates for the USD to INR only. So that will be 18/20 over here. It is a case related to selling points are greater than buying rates. It's really case related to premium of the currency. So these are to be added up, and we are concerned about the selling rate over here. We are concerned about the selling rate over here. So the premium points will be added up. So this points will be related to what rate shall be quoted. 44.65 rate is to be quoted, and further 0.20 forward points are to be added up. So it will be 44.85. So that rate shall be used. So we can write over here that 1 USD is equal to 44.85 INR. 44.85 INR, and we will be just equating these two equations over there. So that basically makes GBP divided by 1.747 is equal to 44.85 INR. That is a relationship, and that is just we need to solve over here. Just keep in mind, we have not added up the or subtracted the margin here on when we are calculating the cross rates. Okay, so it will be 1.747 multiplied by 1.747 multiplied by 44.85, that makes equal to 78 points. So 1 GBP is equal to 78.35295 INR. So that will be the answer related to this particular question if the options are there in GBP to INR. Okay, now let's move further to the another question number 4 over here. So next question over here, it says a customer tenders export bill for GBP 10 lakhs payable 45 days from site. The transit period is given to be 15 days. He wants to retain a margin of 10% in foreign currency. Bank's margin is 10 paise. What amount will be credited to the customer's account over here? So the scenario is somewhat like to the question that we have already solved before. So that says an export bill which is basically received by the exporter, and it is basically worth 10 lakh GBPs. It is basically drawn in 10, it is basically amounting 10 lakh GBPs, and the exporter want to retain 10% of the bill amount, that is 1 lakh GBP he wants to retain as such. And further, for the 9 lakh GBP, the amount is to be credited to the exporter's account over there. So that is a scenario related to given over here. And further, the first line over here is quite important. It says customer tenders export bill for GBP 10 lakhs payable 45 days from site. So whensoever the bill will be presented, it will be paid 45 days thereafter. So what rate shall be applicable, because our settlement date is not the same. So it will be the bills rate which will be applied. It will be the bills rate which will be applied. That is the first scenario over there. And further, it says the transit period is 15 days. Now the transit period in the case of the letter of credit, it is that particular period from the date of shipment and up to the date that the nostro account of the correspondent bank is basically credited. That is the transit period. And for that particular, whensoever the rate is quoted, the transit period is added up to the usage period over there. Now the usage period is 45 days and the transit period is 15 days. So what rate shall be applicable? It will be the 2-month forward rate that shall be applicable. So, okay, so from this particular 2 lines over here, we can infer that 2-month forward rate that shall be applicable. And in that particular case, if the export bill has been presented to the bank, the exporter want to sell the 9 lakh GBPs. Exporter want to sell the 9 lakh GBPs. So what rate shall be quoted? The buying rate shall be quoted. The buying rate shall be quoted. So what rate it will be? It will be the buying rate which will be quoted. So it will be the bills buying rate. It will be the scenario of the bills buying rate. If you remember, what was the formula that was related to spot rate? It was spot rate plus minus the premium or discount. And further, in the case of the buying rates, the exchange margin is to be subtracted. That will be the rate that shall be applicable over there. And over here, the rates are in GBP. So you must be aware that in the previous question, we calculated GBP to INR rate. We just calculated GBP to INR rate, what it was. So we will be considering the USD to INR 2-month forward rate. That is basically for the buying transaction. This is the buying rate that we need to consider over here. Over here, the transaction was the currency is available at premium. So it will be 18 points which will be added up to this rate over here. Okay, because selling forward points are greater than the buying forward points. So it is available at premium. So this 18 points will be added up over here. So what will be USD to INR rate for 2 months forward rate? It will be 1 USD is equal to 44.78 INR. That is a 2-month forward rate over here for the USD to INR. And for the GBPs, the currency is available after 2 months. It is available at discount. It is available at discount because the selling is lesser than buying na. So it is available at discount. And for the what rate we are considering the buying rate over here. So it will be 1.7500 and minus 0.50 minus 0050. So these are to be subtracted. So it will be equal to 1.74 and further it will be equal to 50. So it will be 1.7500 minus 0.550. So it will be 1.7450. That is what rate? This rate is basically related to what? Let me just rub the formula from over here. So that is equal to 1 GBP is equal to 1.7450 is equal to USD over here. So from here we can ascertain the rate related to GBP to INR. GBP to INR. So we can simply say GBP divided by 1.7450 is equal to we are equating the USDs over here. So it will be equal to 44.78 INR. So simply we can basically ascertain the prices of GBP to INR. So that comes out to be 1.7450 multiplied by 44.78. That comes out to be 78. 1 GBP. Let me write it over here. So it comes out to be GBP is equal to 78.1411 INR. So that is the rate for GBP to INR for 2-month forward price. And that is a buying cost. That was related to what cost? That was related to buying cost, because we need to ascertain what price? We need to calculate the bills buying rate. So what was the formula? It was related to forward rate, and further the exchange margin is to be subtracted. So it is 78.1411, and further we will be subtracting margin. But kindly please keep one thing in mind over here. The margin is separately given in the question, that is 10 paise. So the 10 paise margin means 0.10 is to be subtracted. So it will be 0.10 that is to be subtracted. So the answer over here is 78.2411. 78.2411. So what will be the amount that will be credited to the customer account? Because the customer want to retain 10% of the foreign currency na. So only for 9 lakh amount that will be multiplied with this particular amount. So it will be multiplied by with the 9 lakhs over here. The answer will be equal to 70416,990. This amount is to be credited to the customer's account over here. Is that clear? So that would be related to this particular question and this case study. I hope that you must have liked this case study and must have liked this session over here. So kindly please do hit the like button over here, and do not forget to share this video among your friends and colleagues. And you can enroll yourself into the full course videos for CAIIB. You'll be getting the chapter wise full course videos, case study videos, chapter wise previous questions, mock test, and ePDF notes complimentary access to through our Android application over here. So do enroll right now. Visit the website iibf.info, and further if you want to join us on our WhatsApp group, you need to WhatsApp us writing CAIIB, mention your name along with it, and WhatsApp it to the number 83609442007. And kindly please do rate this video, and that would be all. Thank you so much, and see you again in the next video.